Good afternoon and welcome to today's webinar, Construction Audit Fundamentals, Analyzing and Monitoring Project Labor Costs. So I am Robert Zellmer, and with me today is Tanya Beltran, a manager on my team with extensive construction audit experience who frequently reviews and tests project labor hours and costs. So today's topic is one that comes up often in our discussion with clients and owners of capital construction projects. The labor market is one that's been volatile for quite a while now. And in fact, I'm going to share some statistics in a moment that will help demonstrate this. But ultimately, this volatility can lead to some advantageous and sometimes abusive practices that can have a deep impact on projects. And so, reviewing project labor costs and performing a construction labor rate decomposition is important because it provides transparency, accuracy, and control over cost estimation and project management. It breaks down the cost components into their various elements so you can understand what drives the total cost. It improves cost accuracy so you can avoid overestimating costs and missing hidden expenses like union dues or regional premiums, and accurate breakdowns help create realistic budgets and bids. So it also enables benchmarking and negotiation so you can compare labor costs across your projects, regions, or contractors and identify areas for cost optimization and potentially negotiate more beneficial rates with your construction manager and their subcontractors. It supports compliance and audits, so many projects, especially government-related projects or regulated ones, require certified payroll reporting and prevailing wage compliance. And doing this decomposition makes it easier to demonstrate adherence to these rules. And it enhances forecasting and risk management. So understanding the structure of labor costs helps predict impacts of wage increases or benefit changes and model scenarios for inflation or labor shortages. So as we move through our presentation today, our learning objectives are to understand how contract terms related to direct labor impact project cost and risk, learn how to perform a labor rate decomposition and ensure compliance, and explore strategies for monitoring labor charges throughout the project to prevent abuse and ensure transparency. So as I mentioned, the labor market has been experiencing a degree of volatility for quite a while now. And to illustrate this, here are some recent statistics from a leading industry publication. 73% of construction firms list worker shortages as a top concern. 94% of construction firms report having openings for craft workers. 54% are experiencing project delays due to shortages of their own or subcontractor workforces. 61% of firms reported raised base pay for trade and craft workers more than they did in previous years. And 60% of firms are putting in higher bids for projects as a result of labor challenges. So what does all this mean? First and foremost, we've got potential project delays. So a tight labor market means there may be limited resources available for your projects. And without proper staffing on your project, it's likely you can see the schedule slip because contractors don't have the labor required to meet the schedule requirements. This can drive the price of your project up. Extended schedules often mean additional carrying and ancillary project costs. This is often in the form of extended general condition costs from your construction manager, along with other carrying costs for your organization, such as potentially more interest on your construction loan or bonds and extended insurance costs during construction. Additionally, delays can also result in lost production if your facility is intended to generate revenue, which can also have a deep impact. This labor market volatility also increases the price for project labor. As we saw in the previous slide, contractors may be forced to pay a premium to retain skilled workers, which is in turn is reflected in your contract pricing. This volatility can also lead to abusive practices, citing labor shortages as a scapegoat. And we're starting to see things like hidden markups, manipulation of and padding of benefit costs, and the misclassification of workers in order to attain higher rates more often in our projects. So primarily today, our focus is going to be on two strategies. And so that's reviewing your contract for strong terms that create clarity and documentation requirement and enhance project controls and monitoring. So contract terms should preserve your right to perform a labor rate decomposition and audit, and your project controls need to be reviewed so they're able to detect and prevent non-allowable costs and practices when they arise. So as you assess your contract, these are the primary items you want to consider. And as a good reminder, it's always ideal to review these items before you execute your contracts. And while there are steps you can take after the contract is executed to mitigate your risks, your best chance for success comes when you can influence the terms of the contract prior to execution. So number one, identifying terms detailing reimbursement for direct labor. So this is a critical first step, which is to locate the sections that define how direct labor costs will be reimbursed. These terms often appear under the cost of work, labor reimbursement, or potentially a schedule of rates within your contract. Pay close attention to whether reimbursement is based on actual costs, predetermined rates, or a lump sum, as this distinction impacts transparency and auditability. And I'm going to cover a little bit more on this in a moment. Review the reimbursement rates. So once you've identified the reimbursement structure, review the actual rates themselves. So are they aligned with industry benchmarks, union agreements, or prevailing wage laws? So check for consistency across trades to confirm as well that premium rates such as overtime or holiday pay are clearly defined and justified. And in a few slides, I'll walk through a case study that covers performing a labor rate decomposition, along with the risks, impacts, and ways you can assess each area of cost. Confirm what is included in the labor rates. So clarify inclusions and exclusions. Labor rates always include more than just wages. They bundle together fringe benefits, payroll taxes, insurance, and sometimes overhead and profit. So confirm what's included, right, to understand what you're paying for and avoid duplicate charges. Review escalation terms. So this is another important term that oftentimes goes overlooked. So construction projects can oftentimes span months and years. So escalation clauses should be common. And I say should because many times in our audits, this key term is either left out of the contract or it's vaguely defined. So review how and when labor rates can increase, whether tied to union agreements, inflation indices, or annual adjustments, and ensure escalation triggers are clearly defined along with the documentation requirements to prevent unexpected cost spikes. Verify documentation requirements. So this is going to be key for you to verify compliance as you audit and review labor throughout the project. So verify what documentation is required to support labor charges. Contracts should typically mandate items like payroll reports, timesheets, and possibly third-party verification. Strong documentation requirements protect both parties and reduce the risks of disputes and regulatory requirements. So by systematically reviewing these 5 areas, you can ensure labor costs are transparent, compliant, and well controlled. So as you consider your contract terms, here are some red flags to be aware of. So one of the biggest flags is when labor rates cannot be audited. If the contract does not allow verification of actual costs or supporting documentations, you lose transparency and control. and you want to ensure your audit rights are clearly stated. This protects against inflated or fabricated charges. Rates that seem unusually high or low should trigger additional scrutiny as well. So excessively high rates may indicate hidden markups or misclassification of roles, while very low rates could signal underpayment or non-compliance with prevailing wage laws. So this should trigger additional review, such as a labor rate decomposition. So during this process, you're going to analyze the various components of the proposed rates and reconcile to the support provided by your contractor, so you can benchmark these rates against comparable projects, industry standards, and/or union agreements that are applicable in your area. No weekly billable cap for hours on exempt employees. So without a cap on billable hours for exempt staff, contractors can bill excessive hours without accountability. So remember, contractors do not incur actual costs when salaried employees work more than 40 hours per week. Typically, the basis for a guaranteed maximum price contract is actual cost, and therefore, while a salaried employee may work more than 40 hours in a given week, as most of us often do, there's no additional cost related to this time, and therefore should not result in additional billings. So a best practice here is to set weekly limits for salaried employees directly in the contract and require approval of overtime for any hourly employees. If the contract lacks estimated staffing budgets, you essentially have no baseline for monitoring labor costs, and this opens the door to uncontrolled staffing and scope creep. So your contract should include detailed staffing plans with cost estimates for each role. And additionally, ambiguity in roles and responsibilities is a major risk as well. So contractors may bill high-level rates for tasks that require lower skilled labor. The contract should define each role, its responsibilities, and the corresponding rate. And as well as, no limitations on annual increases. So as I previously mentioned, contracts without caps on rate increases can lead to significant cost escalation over multi-year projects. So look for clauses that tie the increases to objective indices or set a maximum percentage each year. Spotting these red flags early on can prevent cost overruns, compliance issues, and disputes. And always review your labor terms with a critical eye and insist on transparency, clear definition, and reasonable controls. As I previously mentioned earlier, some additional contracting items you need to consider is, how will the labor rates be billed? So the labor billing terms themselves can significantly impact project cost control and risk management. And the three most common approaches to billing are at actual cost, an agreed upon rate schedule, and as a lump sum. So each of these has some advantages and some risks, and the considerations you should apply when reviewing these terms include: when labor is billed at actual cost, transparency and documentation are critical. So we want to ensure the contract requires detailed timesheets, certified payroll documentation, and proof of fringe benefits. We also need to confirm that we have the right to audit the labor records in order to prevent inflated charges. We then want to look for caps on reimbursable hours and prior approval for overtime. So the risks we're really looking for here is that billing at actual cost can lead to uncontrolled spending if not monitored closely. So billing at agreed upon rate schedules can provide predictability, but they do require clarity. In fact, this is the method we most often see, and oftentimes agreeing on the rates upfront leads to more efficient monitoring throughout the project, and can also build trust and accountability upfront when both parties understand the terms and requirement. So here you should confirm what's included in the rates. This is your labor rate decomposition. So looking at the wages, benefits, taxes, and overhead. You want to compare the rates to industry standards, prior projects you've completed, union agreements, other published indices, right, to avoid overpayment. As we talked about with escalation, again, here it's important to understand how and when these rates can be increased, and we need to tie these to both objective benchmarks and documentation requirements. And here we need to ensure the roles and responsibilities match the rates applied to prevent misclassification of costs. Lump sum billing shifts the risk to the contractor, but it can introduce other challenges as well. So what we need to be clear on here is the scope of the labor. We need to confirm the labor scope is well defined to avoid disputes over what's included. We want to ensure that there is a clear mechanism for handling scope changes without excessive markups. And we also need to be able to perform performance monitoring. So even with a lump sum, we need to be able to track staffing levels and progress to ensure that we receive the value for the money that was paid. So for example, if you paid upfront as a lump sum for 4 full-time staff to manage your project, can you confirm, in fact, that all 4 individuals worked on your project full-time? And if you find they didn't, then do you have the recourse to pursue credits for any services you did not receive? And this, in fact, is the primary risk here. So lump sums can in fact incentivize cutting corners on labor quality or staffing, so it still requires you to monitor your deliverables closely. So each of these billing methods has pros and cons, and the key here is to apply rigorous review, verify documentation, clarify inclusions, and set up controls to protect your project from cost overruns and compliance risks. So in closing our section on contract terms, we want to always require detailed labor rate breakdowns and supporting documentation, define allowable costs and billing procedures in the contract. We're going to audit our labor charges regularly, and we're going to monitor for duplication, markups, and non-compliant charges. So getting into performing a labor rate decomposition, let's first start with the definition. And so I mentioned this briefly before, but this is really the process of breaking down an hourly labor rate into its individual cost components to ensure transparency, compliance, and accuracy in billing. And so we've talked a lot about contracting terms and risks up to this point, but it's worth mentioning the benefit of performing this task as well. And so this process and the ensuing negotiations with your contractor can be tedious, but remember, your projects often involve thousands of labor hours, and even some of the seemingly smaller savings on an hourly basis can have a material impact on your project. So, for example, we recently helped perform an upfront analysis for a client where we helped negotiate and reduce the labor burden percentage applied to their base wages down from 63% to 61%. So 2% on the surface may not seem like a very significant impact, but over the course of this project, this resulted in over $500,000 of savings, as it was a multi-year project, and as I mentioned, it involved thousands of hours of labor. So as you think about your project budgets, it's important to consider how this upfront analysis can both reduce your contract costs and then potentially free up dollars to pay for some of the other things in your budget and on your wish list that you might want to add to the project as it progresses. So let's start out the discussion on performing a rate decomposition by going through some of the key risks related to labor pricing. And so the first of those is overstated or unsupported base wages. And so what you may see are proposed hourly wages that are higher than actual payroll costs or include future wage escalation without proper documentation. And this leads you to pay more than necessary especially on multi-year projects if increases are not justified. So you're going to want to require payroll reporting to reconcile against proposed rates. And for multi-year projects, you're going to want to demand documentation for any rate increases, be it via promotion, merit, or cost of living. Excessive or incorrect labor burdens. So labor rates include burdens such as payroll taxes, workers' compensation insurance, health and welfare benefits, pensions, and these can often be oversighted or not adjusted at all for the actual wage basis. And owners are sometimes charged for costs that are not necessarily incurred, or for embedded markups hidden within these burden percentages. And so here again, you're going to request detailed breakdowns and supporting documentation for each burden component and compare those proposed rates to either statutory limits or actual cost support. Duplication of charges. So fringe benefits, especially things like vacation, sick time, holidays, these might be included in the labor rates, but then also potentially billed separately, resulting in double charges. So your analysis needs to clarify which costs are included in the hourly rate versus which are reimbursed separately. Inclusion of non-allowable or subjective costs. And so we often see embedded costs like overhead and profit, bonuses, or discretionary employee payments, which may not be valid project costs included in rates as well. In turn, we see where owners are billed for costs that don't directly relate to the project and are not permitted by the contract terms. So as you review these rates, you want to scrutinize all components of the labor rate and require justification for each. You can also set limits on expenses and define what is reasonable within your contract documents as well. Lack of transparency and documentation. So insufficient detail in labor rate calculations can obscure hidden fees, markups, or profit margins, and subsequently, owners are not able to verify the reasonableness of charges, increasing the risk of potential cost overruns and disputes. So you can avoid this by setting terms in the contract upfront that require all supporting proper documentation, and then following through on your right to audit and reviewing these rates prior to incorporating them into the contract documents. Labor shortages, regulatory updates, or market shifts can impact agreed upon rates as well, leading to unexpected cost increases or compliance risks. So contractors may seek rate adjustments mid-project, or owners can even face penalties for non-compliance. So you will want to verify your contract includes provisions for rate adjustments that are tied to documented market or regulatory changes, and then monitor compliance throughout the project. So as you consider your labor rate decomposition, here are the typical steps to follow. So number one is gather your source documentation. So obtain payroll registrations, labor distribution reports, and review the contract terms that specify agreed upon labor rates and allowable burdens. Break down the hourly rate into its components. So this is base wages, payroll taxes, workers' compensation or other insurances, your employee benefits, and other burdens that may be included, such as training costs, equipment, union dues, and other costs. And look for overhead and profit markup as well that may be included in the rate. So what you're going to do then is you're going to recalculate each component of the rate itself. So starting with the base wage. So for annual salaries, you're going to look at the support for the salary for that individual and then divide that by 2080 to get your recalculated hourly rate. And you're going to compare that to the proposed rate. If the employee is paid hourly, you're going to look at the payroll reporting and again compare this to the raw wage. Compare this raw wage to the proposed rate from your contractor. Payroll taxes. So you're going to look at any federal and statutory rates, and you're going to compare those to what's being proposed and verify they're calculated correctly. And so here it's important to understand that annual caps on these taxes, as they're often not accounted for properly in base wages. Things like workers' compensation or general liability insurance that may be included in the rates. You'll want to look at the contractor's actual premium for these rates. So they should be able to provide you a rate determination letter demonstrating their current premium. For things like workers' compensation insurance, if this can't be provided, you can typically find the rates posted on your state's applicable workers' compensation website. And this can be used as a reasonable test for your contract. This can be used as a reasonable test as your contractor's actual rate would be adjusted by their experience modifier that takes into account how many claims they've had in previous years. For benefits and other burdens, you're going to want to request support from the contractor to determine how they arrived at your hourly rate. And you're looking to verify the rate appears reasonable based on the support provided and that you can arrive at the rate proposed by your contractor. As you perform this reconciliation, right, you're going to compare these actual costs that you've recalculated to the rates proposed by your contractor. So you're going to perform these two steps in conjunction, and then you're going to benchmark and analyze the decomposed rates to local rates that you've observed in the industry. Could be local prevailing wages or other industry benchmarks to identify any variances. And then along the way, you're going to document your findings and recommendations. So you're going to want to highlight any overcharges, potential duplicate costs, or non-compliant charges you may have found, and discuss these with your project management team during negotiations. If you perform this analysis after the contract has been executed, it's still worthwhile to document your finding, as these observations can be used for future recommendations to improve your contracts, improve your documentation requirements, along with your audit procedures. And so, as I mentioned before, I was going to walk through a case study example. So the next several slides show an actual rate decomposition where applicable, we've left in the rates proposed by the contractor for the purpose of this discussion. So first and foremost, we've got base hourly wages. So as I talked about, right, we want to see actual support from the contractor to ensure that these rates aren't overstated. We're looking for things like if it's a multi-year project, we want to actually see the method by which they potentially will escalate these rates year over year. Looking for whether or not they've averaged out previous or upcoming years' escalation into the rate to ensure that we're actually paying actual cost. FICA and Medicare, right? This particular contractor broke them out into two separate lines, but we often see this in one line within the labor rate decomposition. This one is a pretty straightforward calculation. FICA should always be 7.65% of the base hourly wages. One thing that's important here is you're always going to want to look at how these rates are adjusted for overtime, specifically for your hourly employees. If you see the aggregate proposed rates increase by 1.5 times the rate for overtime or 2 times the proposed rate for double time, this is going to be an immediate red flag. So in most instances, the components of labor burden only apply to the straight time rate and therefore should not be calculated and considered in the premium time rates. So SUTA and FUTA, these are often rates that we typically see overstated. So many times what we particularly see is these rates are oftentimes not adjusted for the annual caps. And so in this particular instance, this project was one that was being done in California. So California's SUTA rates at the time were 1.5% to 6.2% on a taxable wage base of up to $7,000. So this equates to an annual cost of $105 to $435 per year per employee, or 5 cents to 21 cents per hour. So again, as we look at this rate, right, and we compare that to the proposed rate of 15 to 72 cents per hour, we can see we've got a pretty significant variance here. Same thing for the federal unemployment tax. So the typical rate is 0.6% on a wage base of $7,000. So again, this equates to an annual cost of $42 per year per employee, or approximately 2 cents an hour. And again, we compare that against what this contractor had proposed, which was 17 cents to 77 cents per hour. And again, we've got a pretty significant variance here. Workers' compensation, again, so what we're looking for on workers' compensation is to look at the actual cost support for it. So again, we saw a differentiation here between the management employees and the labor employees, right? And now what we need to actually see is what that contractor's actual rates are. So again, they should be able to provide you a rate determination letter that shows the actual rates they're paying for the different classes of labor. Right, moving on with our decomposition that we performed, the top one on this slide, this SDI here, right? This was actually a state disability insurance. And again, here, the risk we're looking at is an overstated rate. But in this case, as we did our research into what this cost was, we found out that in this particular case, this was actually a payroll deduction, and the employee was responsible to pay this cost. So in this instance, the construction manager was solely responsible for just withholding the deduction and then submitting it to the state. So again, we wouldn't expect to see this within the actual labor burden itself. Then we've got health and welfare and pensions. So the key risk here, right, is we're trying to ensure that these rates are reasonable and they're not overstated. And so what we want to see from our contractor is something that clarifies specifically what's included in these rates, who's eligible for them, and how do they arrive at their rates that they're showing here of 15% and 10% of the base wage. Some key questions to ask here are for things like healthcare and benefits, right? Is what if the particular employee working on your job isn't enrolled in the benefit? Should you still pay the cost of that? Or for any type of pension or 401k or 401k benefit, specifically there as well too. If the employee doesn't take advantage of that, right, should you, the owner, be responsible for paying those costs? All right, moving through again, we've got vacation and sick time of 3% of the base wage. So again, what we're concerned about here is duplication of benefit hours. Again, we want to see the breakdown. We want to understand what the vacation policy is. We want to understand what holidays are included in this. We want to see, what their policy is for sick time. And then on top of that, right, if we're including the cost of these benefits within the labor billing rate itself, as we audit the project, we would expect that we wouldn't see charges for those individual hours. Moving on, we've got safety equipment and training costs. Again, here we run the risk of duplicating reimbursable costs on top of potentially paying for costs that are considered overhead and would be non-allowable by the contract terms. So what we want to see specifically from the contractor is documentation telling us exactly what's included in these costs and how they arrived at the percentage they're including in their rate. Similarly with the core services, again, we want to make sure that these costs themselves are actually allowable per the terms of the contract, and we don't risk any duplication of costs with the contractor's general conditions. And then we move into, this particular contractor had included a lot of vehicles in their reimbursable rates. Now, they did break it down by the level of employee, but then that begs the question itself. So on a project, you should expect to pay for vehicles for folks that are on site on a daily basis, right? This is your superintendent, your project manager, maybe there's an assistant project manager or multiple individuals that are on that site every day. So it's reasonable to expect to pay vehicle costs, right? Therefore, again, though, we want to make sure we understand how that's being charged to the project so we don't potentially pay these costs twice. But this begs the question, though, is for folks like the senior advisory staff for the contractor, the project accounting staff, those folks that may not be located on the job site, those folks that may only touch the project intermittently throughout. Should you be paying their vehicle costs? It's a question to ask and something to negotiate with your contractor. Then we get into mobile phones and tech costs. So again, here we're looking to see exactly how the contractor builds to those rates. And for things like tech costs, right, we want to understand exactly what's included in this category of costs. So certain items like the contractor's ERP system, we would consider overhead and therefore not reimbursable on the project. So we want to make sure that we're requesting support from our contractors so we understand exactly what we're paying for before we agree to these costs. So closing out our discussion on labor rate decomposition, we've got some keys to success, and those are: ensure your contract terms allow for the rate decomposition, perform your analysis prior to agreeing to the hourly rates, benchmark them to comparable projects or published resources, and document your results. And at this point, I'm going to hand off the presentation to Tanya Beltran, who is going to walk through how to review, audit, and analyze project labor throughout the construction phase.
Thank you, Bob. So when we start direct labor testing, the very first step is reviewing the contract itself. This step is critical as the contract lays out the rules for how labor should be billed and documented. As you go through the contract, you should be looking for key items such as the billing method for labor. You should be asking yourself, is labor billed at agreed upon rates, or is it based on actual costs? For example, some contracts lock in a fixed rate, like $65 an hour for a project manager, while others require billing on actual payroll costs plus burden, as Bob previously mentioned. You also want to check what the contract says about overtime. Is overtime allowed, and under what conditions? You'll see that some contracts might allow overtime, but only with prior written approval, or it might specify that contract or that overtime is billed at 1.5 times the straight time rate. You also want to look for language restricting how many hours exempt employees can bill. For instance, the contract may state that salaried employees are not allowed to bill more than 40 hours per week, even if they worked those extra hours. You also want to check the contract related to any language on documentation requirements. This could include certified payroll reports, signed timesheets, or job site sign-in logs. Identify these requirements up front, ensuring you know what's allowed and what's not, and where the potential risks may exist. So once your contract review is complete, the next step is to develop audit procedures. I'll be covering the detailed audit steps later, but for now, I just want you to remember that your audit procedures should align directly with the contract terms and the risks that you've just identified. After you develop your audit procedures, you'll need to determine your testing population. Are you looking at all the labor charges for a specific period, or focusing on a targeted sample, such as high dollar employees or those with significant overtime? So once your population is defined, you'll then want to gather all the documentation, such as timesheets, payroll registers, and so on from the contractor to begin your testing. And as you go through your testing, always ensure your results are documented clearly. Confirm whether labor charges comply with the contract, note any discrepancies, and also provide support for your conclusions and recommendations. So the checklist you see here is our labor risk assessment tool. It details all the key risk areas we look at when auditing labor risk. It's an essential tool as it helps us identify the most common risk in labor billings and ensures they're addressed. By starting with this assessment, we can really pinpoint the potential risks up front, which then guide the audit procedures we develop. I'll walk you through these risks in more detail on the next few slides, so keep this checklist in mind as we go. All right, so let's talk about some common risks we often see in labor billings. One risk is that the contractors charge for employees who are not working on the project, or in some cases, employees who don't even exist. Another risk is billing for hours not actually worked. A frequent issue we come across is contractors invoicing for more hours than what's recorded on an employee's timesheet. In a recent audit, actually, we found an employee was consistently billing for full 8-hour days over several weeks, but when we reviewed the timesheets that were submitted, it turned out that the employee was only working half days, so just 4 hours. But despite this, the contractor continued charging for those full 8 hours each day, which resulted in an overcharge that was ultimately credited back to the owner. Contractors may also bill labor at rates higher than agreed upon rates. For example, we've seen a contractor incorrectly charge a labor at the foreman's rate or an estimator at the superintendent's rate. Another common issue we see is when the contract specifies that labor should be billed at cost, but the contractor actually charges more. Bob touched on this in previous slides, but I'll just give a quick run through. So the contractor may charge more than the actual cost if the rate billed is higher than what the employee actually earns. Also, overtime and double time rates could be applied incorrectly. Fringe benefits, as Bob mentioned, may be inflated. And we've also seen that some subjective bonuses are included in the labor rates. A common issue we actually see is double charging for PTO. We saw this recently on a university renovation project that we're auditing. PTO was already built into the hourly labor rate, but then the contractor also billed separately for the hours the employee was off-site and on paid time off. So this resulted in the university paying twice for the same benefit. Employer taxes on labor are another area where errors can occur. Contractors may use the wrong tax rates or fail to apply wage limits when calculating unemployment taxes. The contractor might also apply FUTA and SUTA taxes on overtime and double time wages, which is not correct. Those taxes should only apply to base wages. Insurance costs can also be miscalculated or billed twice. We've seen cases where the contractor includes general liability costs in the labor rate calculation and then bills them again as a separate line item. Beyond taxes, other insurance costs can also be embedded in labor rates, even when they have no relationship to labor hours, such as auto insurance or umbrella policies. We also see overhead costs included in labor rates, such as small tools, trucks, office overhead, or even data charges. These are not direct labor costs and should not be billed this way. Also, let's not forget simple math errors. Even small calculation mistakes can add up over the life of a project. This is why detailed reconciliations and periodic audits are so important. So now that I've swiftly covered some few common risks, let's walk through the actual testing steps. The first step is verifying employees. This is where we confirm that the people billed to the project were authorized and worked on site. You'll start by preparing an employee timesheet schedule. This means creating a complete list of all employees who worked on the project during the period of testing based on the timesheets that were submitted. Next, you'll want to cross-reference the names on the timesheet schedule with those in the certified payroll records. Certified payroll is an official compliance document, so any legitimate employee should appear on there. This gives that extra layer of verification. You'll then want to reconcile the job trailer sign-in sheets with the timesheets. This step helps confirm that the hours billed were actually worked on site. Lastly, compare the timesheet schedule to a list of employees authorized to work on the project. The list of authorized employees could come from the contract itself, project rosters, or approved staffing plans. You want to look, when looking at the timesheet schedule and comparing it to the list of employees authorized to work, you want to look for discrepancies such as timesheets submitted for employees not on the authorized list or missing timesheets for approved staff. By vouching for employees, checking authorization, confirming prices on site, and inclusion in official payroll records, you ensure that only real, properly documented labor charges make it through the project. So after verifying the employees, the next step is to make sure the hours they billed are accurate and compliant with the contract requirements. So now we're going to be moving on to verifying the labor hours. You'll begin by reconciling the hours recorded on the timesheets against both the hours billed and the certified payroll hours. This ensures overall consistency across all records. Specifically for overtime hours, you'll want to verify that any employee charging more than 40 hours per week is non-exempt. On a recent audit, we actually discovered that the contractor was billing overtime for salaried employees, even though the contract specifically prohibited overtime for those roles. These charges were not compliant with the contract and were credited back to the owner. Also, for overtime, you want to check for fairness and overtime allocation. Make sure no single employee is consistently given overtime preference. Lastly, you want to review the reasons for the overtime. Was it incurred or did they meet a financial? Was it incurred to meet a financial milestone or deadline, or was it due to poor labor management? Overtime should be justified and not just to cover up inefficiencies. For premium time hours, you want to reconcile the dates these premium time hours were charged with field journal and project reports to confirm that the premium rates were warranted. You also want to make sure that the time wasn't billed for routine work or without proper authorization. Overall, the verification of labor hours is essential for preventing overbillings, detecting errors, and ensuring compliance with the contract terms. So once labor hours are verified, the next step is to make sure that the rates and burdens applied to those hours are correct. You'll start by listing all the labor rates for each employee classification, such as laborers, foremen, superintendents, and so on. The schedule becomes your benchmark for testing. You'll then select a sample of employees to test and recalculate their gross pay. You'll use the hours worked and the agreed rates based on the contract, and then compare your calculation to the certified payroll records. You want to make sure that the math checks out and the rates align. After that, you want to cross-reference your labor rate schedule with the certified payroll itself. Every employee bill should appear in the certified payroll, and the rate should also align. Now to verify the labor burden rates, Bob touched on this earlier, but you'll just want to review the supporting documentation for each burden component and confirm that the percentages applied are accurate and reflect actual cost. The final step in direct labor testing is to reconcile all the calculated labor costs with the actual labor charges billed to the project. You'll want to sum up all the labor costs you've calculated. So you'll have raw wages, payroll taxes, insurance, benefits, and other burdens, and then compare this total to the actual amount billed. Make sure you document any differences you find, whether it's overbilling, underbilling, or errors in calculation. And as Bob discussed during the case study, you also want to perform a billing rate analysis by decomposing the labor rate into raw labor and burden and following the steps listed here in the slide. I'll be handing over the presentation back to Bob to discuss fraud considerations.
All right, thank you, Tanya. And as Tanya mentioned, lastly in our webinar here, we're going to talk through some fraud considerations to be aware of, as this not only results in higher project costs, but it can also result in compliance and legal risks, reputational damage and opportunity costs, or essentially funds that are lost to fraud, they reduce your ability to invest in other projects and enhancements. And so here we've listed out some of the most common labor fraud schemes. So we've got ghost employees, so adding fictitious workers to payroll or timesheets to inflate labor costs. Tanya already mentioned already, inflated or false timesheets, misclassification of workers, off the book payments, so paying workers in cash to evade payroll taxes and insurance premiums. We've got workers' compensation fraud, and then we've got kickbacks and bribery or collusion between contractors to inflate labor costs and secure contracts. And so labor fraud in itself, it's not just a compliance issue in construction projects. It actually drives cost overruns, it exposes the project to legal risk, and it erodes profit margins and ROI on the project. And to best illustrate some of these, I'm going to go through just a couple of brief case studies. And the first one here involves a New York contractor that was implicated in a fraudulent overbilling scheme. And so they had actually gone and inflated their foreman's timesheets and were billing clients for hours that were never actually worked. And so some of the foremen were actually guaranteed 4 hours of overtime every day, regardless of whether or not they worked those hours. And then when the foremen were on vacation or sick leave, the contractor still billed the clients as if they were on site. So this fraudulent billing affected several high-profile projects, including a hospital, as well as capital construction at a community college. And the company themselves agreed to pay over $7 million in penalties and restitution under a non-prosecution agreement. And so even small systematic overcharges like these can accumulate into millions of dollars over time, and weak internal controls and lack of oversight creates these opportunities for fraud. On a similar case, we saw where a contractor operating multiple drywall businesses in one state was engaged in a payroll fraud scheme involving worker misclassification. So in this case, the employees were actually labeled as independent contractors to avoid paying taxes and insurance. This, in fact, resulted in over $500,000 in unpaid taxes and $2.3 million in liens. And so this contractor faced jail time, and the broader issue here is these types of misclassification schemes often lead to wage theft, unsafe working conditions, and potentially lack of workers' compensation coverage. And so why these cases matter is both example highlights of common fraud patterns, be them inflated labor hours, ghost employees, and misclassification, and they resulted in criminal charges, restitution, and reputational damage to not only the contractor, but the owners that they were working for. And so some of the red flags to look for, and some of these align with your audit procedures as well too. So you're looking for duplicated or altered timesheets, unusual overtime patterns, payroll records that don't match job site logs or security sign-ins, labor classifications that are inconsistent with your contract terms, or frequent change orders involving labor adjustments without clear justification. And some of the audit strategies, again, that can help uncover this, follow your audit program, right? So we've got timesheet and attendance verification. So comparing those timesheets to job site logs, security sign-ins, and the project schedule. Worker identity and classification. So verifying worker identities on site, looking for ghost employees, and ensuring the labor classifications match up with the contract scope. Confirming the legitimacy of subcontractors and investigating whether or not you have shell companies or phantom vendors on your projects. And all of this all of this can be done by doing regular job site audits. Again, reviewing the documentation throughout the project, performing site visits, spot checking attendance, and validating worker identity.